Hey guys, welcome back to Metro Markets. Today we're breaking down 5 key metrics that are going to help tell you whether a stock that dipped is a real buying opportunity or a straight up value trap. And to make this clear, I'm showing you 2 examples. Meta, which became one of the best buy the dip setups as of late, and MSTR, MicroStrategy, which fails almost every one of these 5 key metrics. Metric 1, business thesis strength. And the very first thing you check is the business thesis. Forget the stock price for a moment. Is the actual business still strong? Is revenue still growing? Are margins stable? Is there still a competitive edge? And is a long-term story unchanged or not? So, buy the dip rule number 1. If the business is healthy, the dip is usually an opportunity. If the business is cracking, then it starts to become a warning sign. Metric number 2 is valuation. A dip only matters if it actually makes a stock cheaper. A stock can drop 20% and still be overvalued and nothing changes. You check things like PE versus history, price to sales, PEG ratio, EV/EBITDA. So if the valuation comes back to reality or starts to become flat out cheap, that's when smart money starts to become interested. Now, metric 3 is understanding why the stock dipped. There's emotional selling and there's fundamental selling. These two are complete opposites. Emotional selling, headlines, election fear, temporary earnings miss, analyst downgrades, lawsuits, panics, short-term noise. Fundamental selling, losing market share, product becoming irrelevant, rising debt risk, and collapsing cash flow. You want to make sure it is an emotional dip and avoid fundamental dips. So emotional selling can be opportunity, fundamental selling shows signs of danger. Metric 4 is forward guidance, and this one is huge. You don't judge a dip by the last quarter, you judge it by the next year. If a company guides higher or maintains strong guidance, dip recovers fast, and if it remains lower and worse forward guidance, that dip can bleed for months. So strong guidance is going to be creating opportunity, whereas weak guidance is going to destroy it. So what the company says about the next year is important. And this guidance goes really well into valuation and PEG ratio, price earnings to growth is very important. Metric 5, free cash flow plus balance sheet strength. This is the foundation. Cash companies with strong free cash flow and a strong balance sheet are going to be able to recover faster than anything else does. An important thing that cash does is lets company buy back shares, reinvest, acquire competitors, pay down debt, and survive recession. Cash can turn dips into slingshots. Big thing that people miss is the fact that a large supply of cash in some of these companies, when share price is dipping too far, they will actually buy back the shares, almost inflating their own valuation. So the 5 metric checklist: business thesis is intact, nothing particularly changed in the company. The valuation is cheaper compared to historically. You want to find the real reason for the selling, whether it's emotional or fundamental. You want strong forward guidance. I would say one of the most important ones is valuation and forward guidance. And you also want a company with good cash. And good cash, I would say, is subject to change more than some of the others, just for the fact that you can have amazing forward guidance and an amazing PEG ratio, but you may not have a lot of current cash flow. Now let's apply these 5 metrics to Meta during the big dip recently. Thesis strength, pass. User growth, strong. Ad revenue rebounded. Reels exploding. AI ads taking off. The business never broke. Valuation reset. Yes, Meta did drop so hard that it traded in a single digit PE for a time, unheard of for a mega cap stock. It literally became a value stock version of cheap. Now, the reason for selling: it was strictly emotional. People panicked. They were worried about spending with Mark Zuckerberg going so aggressive into AI, hoping that it pays off down the road. There are recession fears and a small ad slowdown, but fundamentally, everything was still completely fine. And the forward guidance is very strong. Every quarter, the outlook stayed solid. margins expanded, costs started to get controlled, and AI tools started printing revenue. Now let's look at cash flow and balance sheet, which is excellent. Tens of billions in free cash flow, huge buybacks, and no debt pressure. Meta checked all 5 boxes, and the rebound is starting to look massive. You can already see here we have a V incline, as well as recapturing the 618 on our Fibonacci levels. Now look at MSTR, the opposite of Meta. Thesis strength did not pass. The software business is shrinking, declining revenue, negative adjusted operating income. The company is basically a leveraged Bitcoin vehicle. Valuation reset also did not pass. The valuation does not track earnings or fundamentals, it tracks Bitcoin plus leverage. Traditional valuation metrics become meaningless. The reason for selling is fundamental. Selling happens when Bitcoin drops, debt risk increases, and dilution ramps. These are structural ramps and not emotional. Forward guidance is uncertain. Software doesn't grow, and future depends entirely on Bitcoin. So debt and dilution must continue. Now let's look at the cash flow and the balance sheet for MSTR. They have huge debt, thin operating cash flow, dilution ongoing, and balance sheet strength tied to Bitcoin volatility. So MSTR is failing 4 out of 5 of these key metrics when looking at a buy the dip compared to a falling knife. So here's the truth. Not every dip is a discount, not every crash is a buy, but if a stock is checking all 5 of these simple key metrics, a strong thesis, a real valuation reset, just emotional selling and not fundamental, strong guidance and forward guidance, strong cash flow, then you're looking at a high probability setup with a lot of opportunity. Meta was a clear buy the dip, MS was not. If you want me to break down another stock with this same framework, drop it in the comments. Appreciate you watching Mitchell Markets, and if you enjoyed the video, please subscribe, drop a comment, ask a question. I like to consider myself an option specialist, so if there's any option questions, spread questions, or just diving into some stocks that I am currently playing, swings or trading, then feel free to ask and I'll get to those. Thanks for watching, and I'll see you guys next time. Hopefully you enjoyed my 5 key metrics to keep in mind before buying the dip.